Picture this, it's 2:17 a.m. on a Sunday, you open your phone, and you can buy Apple, Tesla, or an S&P 500 ETF like it's Bitcoin. No waiting for Monday, no market closed, no T+1 settlement, no old school delays, because NYSE's parent company, Intercontinental Exchange, ICE, says it has developed a platform designed for 24/7 trading of tokenized stocks and ETFs, with instant settlement, fractional-style dollar orders, and even stablecoin-based funding. If that sounds like the biggest shift in market structure in decades, you're not crazy. Today on Express Econ Geofinance Insights, we're breaking down what tokenized stocks actually mean, how this could work behind the scenes, why 24/7 trading could change volatility and liquidity, and the one thing that decides whether this becomes the future or a regulated dead end. Let's simplify the announcement. ICE says this new system is designed to power a new NYSE venue where tokenized versions of US-listed equities and ETFs could trade around the clock and settle immediately. Here are the key phrases that matter: 24/7 operations, instant settlement orders sized in dollars, which naturally supports fractional-style investing, stablecoin-based funding, blockchain-based post-trade systems, and even the ability to support multiple blockchains for settlement and custody. Translation: the matching of buyers and sellers can stay ultra-fast and exchange-grade, while blockchain upgrades the after-the-trade plumbing, settlement, custody, and ownership records. And that after-the-trade plumbing is where the entire financial system either evolves or breaks. A tokenized stock is not just a stock on a blockchain. At a high level, tokenization means a real-world asset, like a share of stock, gets represented as a digital token that can move and settle on blockchain rails. But here's the critical part: not all tokenized stocks are equal. There are two main models that define everything: your rights, your protections, and the regulator's attitude. Model 1: issuer-sponsored tokenization. This is where the company, directly or through official agents like transfer services, issues shares in token form, and ownership transfers are integrated into official records. In other words, the token isn't pretending, it's the real thing. Model 2: third-party tokenization. This is where someone else creates the token, and that splits into two subtypes: custodial tokens. A firm holds the real shares somewhere, and the token represents your entitlement. Synthetic tokens: you may get price exposure, but not the same shareholder rights. This can start looking like a derivative. Here's the point: if NYSE is serious about a regulated mainstream platform, it has to be built around tokenized shares that preserve real rights, dividends, voting, legal protections, not look-alike tokens that confuse investors. And regulators have been signaling that exact direction. Most people think the big story is 24/7 trading, but the bigger story is settlement, because every trade has two legs: the stock moves, the money moves. In traditional markets, clearing and settlement involve layers of netting, intermediaries, and time delays. This new model is aiming for something closer to what crypto does: delivery versus payment, DVP, where the asset moves only if the money moves. In the best-case version, it's close to atomic settlement: stock token transfers, cash token transfers, both finalize together. Now, about that cash token, NYSE mentions stablecoin-based funding. That matters because a 24/7 market needs 24/7 funding rails, but institutions are also exploring another route: tokenized deposits. Traditional bank deposits mirrored on blockchain rails so cash can move in programmable workflows under controlled, regulated frameworks. This is crucial. 24/7 tokenized stocks don't work at scale unless money, collateral, and risk controls also evolve into a near real-time operating model. So if you're watching this story, don't just watch the trading headlines, watch the money leg, because whoever controls the money leg controls the system. Now let's talk about the part nobody wants to say out loud. 24/7 access does not guarantee 24/7 liquidity. In fact, if markets go always on, we might see a two-speed market: deep liquidity during US daytime, thinner liquidity overnight and weekends, and thinner liquidity often means wider spreads, sharper candles, more sudden gaps, and more price moves driven by smaller orders. That's not automatically bad, it's just reality, and it could reshape behavior: more global participation, more real-time reactions to geopolitical events, more retail-driven movement during off-hours, and a new world where price discovery doesn't wait for the opening bell. In a 24/7 environment, Monday morning gap could become Sunday night drift. But here's the cliffhanger. If liquidity is thin off hours, does 24/7 trading stabilize markets by letting news price in continuously, or does it create a new volatility machine? Let's go there next. There's a powerful argument for 24/7 markets. When big news hits, war, elections, emergencies, surprise earnings, the market can price it instantly instead of bottling pressure until the open. That could reduce giant gap moves, but there's also a powerful argument against it. If the market is open while liquidity is thin, price can move more violently on smaller flows. Add in social media, global headlines, and retail FOMO at 3 a.m., and the market could develop a new rhythm. Microshocks, instead of one big shock. So instead of one big Monday move, you get constant repricing, constant hedging, constant risk management. And if you're an institution, that means surveillance and monitoring must be 24/7, operational staffing becomes continuous cybersecurity exposure increases and downtime becomes a market integrity event, not just an inconvenience. Always-on markets raise the bar for resilience. Now, the hard truth. This story lives or dies on regulation. US regulators have been very clear about one principle. A security is still a security, even when it's tokenized. So NYSE's tokenized venue has to solve questions like, who is the regulated custodian? How are investor protections enforced when assets are in wallets? How do you prevent synthetic tokenized stocks from misleading people? How do market halts, volatility controls, and surveillance work 24/7? How do corporate actions, dividends, and voting rights flow cleanly through token rails? And how does this integrate with existing settlement infrastructure without creating loopholes? If NYSE gets this right, it becomes a blueprint for regulated tokenization. If it doesn't, it becomes another great idea that never escapes the approval process. Big picture, this isn't just NYSE copying crypto, it's Wall Street admitting something deeper. Blockchain is evolving from a speculative asset class into financial infrastructure. If this model works, the future could look like tokenized stocks, tokenized cash, programmable collateral, faster settlement, global market access without time zone friction. But the winners won't be the loudest hype projects. The winners will be the systems that are faster, safer, compliant, and scalable. Drop a comment. Do you think 24/7 stock markets will make markets more stable or more chaotic? This is Express Econ Geofinance Insights, where economics, geography, and finance collide. Like, subscribe, and I'll see you in the next one.